Dan Wilton, CEO of First Mining Gold Corp, joins us once more. He's back with us to talk about not just the outlook for gold, but also talk to us about the operations of First Mining Gold. We're going to take this as a case study for what has gone right for the mining sector. Welcome back to the show, Dan.
David, thank you very much. It's always a pleasure to see you. And let me tell you, it hasn't gone right all the time. It's a tough business, this mining business.
Listen, look, people know you're paying me for this interview, but that was an objective fact, okay? There's a lot of good things that happen with the First Mining Gold Company that we're going to talk about, including news releases. But I started with the program by saying that because the stock has gone up 255% since the beginning of last year, over the last 12 months. And I don't have to mention that it's been an outperformance when it comes to a stock in a gold mining sector relative to the price of gold. Now, not all gold mining stocks have outperformed to the same degree. The stock saw a significant slump in the first half of the year, down 55% before recovering to near all-time highs again. So let's just talk about what happened over the course of the last year, and then we'll narrow down on the recent developments. You've had regulatory approvals for the First Nations communities in your area, as well as environmental assessments that are significant in advancing the Spring Pole project, which is in Northern Ontario. So you're one step closer to production, which is significant to the value unlocked for shareholders. But I'll let you explain that in more detail. What happened to your stock in the last 6 months to 12 months?
Yeah, so let's go back to 12 months. We've been in this environmental assessment process, for 8.5 years. And the end of 24, beginning of 25, we were going through the final stages of that final environmental assessment. And lots going on the public record, I think, but we were always confident on the direction that we were going in. And, committed to getting to where we've got to so far with the Indigenous communities that we're working with. So, obviously, the first little peak there is the gold price is running, right? And that's where, call it from September, October last year, share price goes from, 20 cents to almost 80 cents. But a lot of that is momentum and gold price driven. We have two of the largest undeveloped gold projects in Canada and continue to make progress at Spring Pole. But I'd say that was recognition of fundamentals, but a lot of that sort of the gold price momentum. The pullback that went from there, call it from January, February, you saw a pretty similar chart for most kind of gold developers like us, and that there was enthusiasm with the gold price going over, $5,000, almost $5,500, and then pulling back. So from there, for us, it kind of resettled in this, call it 50% or 50 cent-ish range. But got pushed down a little bit, and, investors waiting for us to deliver on these milestones. That process ran a little bit longer than we expected, but in the grand scheme of things, not that much longer. That left us to the point of having some really important achievements here over the last couple of weeks, including announcing, term sheet agreements with Cat Lake First Nation and Lac Seul First Nation a couple of weeks ago, which is what started that latest push in the middle of June. And those agreements were, similarly years and years in the making. And then, announcing on Tuesday a term sheet agreement with Slate Falls Nation, and the announcement of the environmental assessment approvals, which just demonstrating, that last push up is really just catch up on that fundamental value. It's the work that's been going on for, 10 plus years, certainly all the 7.5 years that I've been here. But it finally kind of coming to fruition. So there's still lots of work to do on that front. We got to get these term sheet agreements into full, project agreements with the communities. But we've got a pretty clear path charted to go forward there. And we still have to get through the provincial environmental assessment process, targeting that being done kind of by the end of the summer. But that's, at the end of the summer, we'd like to be in a position with really all of the communities with these long-term project agreements in place and the environmental assessment approvals that then really allow us to move on with confidence into finalizing feasibility study, detailed engineering, permitting, and moving towards that construction decision, which we'd be targeting kind of beginning of 2028.
So it's really a combination of a lot of different agreements and things we're waiting on happening at the same time in the last month, I would say. So the stock went up, let's say, about 70%, almost double just in the last month alone, whereas gold has fallen. So this move was, fair to say, captured entirely by company-specific events and not by the market itself. So this is an example of movement that is triggered by different milestones all happening at the same time. So if an investor were to ask you, Dan, well, let's use this as a case study. I don't know if this is applicable to my other mining investments. How do I know if a company is near completion with an agreement with either First Nations or, let's say, with an EA that's ongoing?
Yeah, the short answer is the agreements with communities, you don't know unless you're in the room to have those discussions. And those are things that can't be rushed. And we've learned that certainly as we've gone through this process. One of the challenges that communities have is having access to enough capacity funding to really be able to understand these projects and be able to participate in these permitting processes. So, it's a process of building relationships and trust, and that takes time. Really for us over, let's say, from 2020 to 2025, our time frame maybe slipped 6 months over 5 years of permitting, and I think we would put that time frame up against just about anyone else who's been developing projects in the mining industry. I think we've done a good job at delivering on that, but need to continue to deliver on those milestones.
So the recent move on the EA bumped the stock up 33% since a couple of days ago. The stock saw significant movement intraday on June 30th, and then it sold off a little bit. I guess people sold on the news. But this is what happened here. So Federal Environment Minister Julie Aviva de signed off on Springpole after an Impact Assessment Agency of Canada's ruling that the proposed open pit is not likely to cause significant adverse environmental effects. Just explain to an investor who does not have a geology background or a mining background why an EA being passed is significant for advancing the shareholder value of the company or unlocking NAV, so to speak.
Yeah. Well, this is the single largest gating item for your environmental permits, right? And for your regulatory permission to move a project forward. And now that we've got that federal EA decision, I think it allows investors, hopefully forces some investors, to have to judge the project on its merits. Have to judge it by the tons and the grade and by the pre-feasibility study that we have out and the game plan that we're moving forward, continuing to work with the communities. So, I think when you look at this project, it's always benchmarked really well against some of the best new mines in Canada.
A few questions on the EA itself. The article I read says that the process began in April 2018. So why did it take almost 10 years?
It actually began in February 2018.
Oh, February 2018. Okay.
Yeah.
That's a mistake in the print here. But anyway, 2018. Walk us through the timeline here. I'm guessing that's not abnormal, but still, it takes. If somebody outside the mining sector would wonder, why am I investing in something that takes 10 years to possibly approve?
Yeah, right? Just to get your first environmental assessment approvals. And, for us, this project, by nature of its definition, by nature of, what you need to do to advance the project, the working with the infrastructure around the lake, it was going to take a little more time. There was more baseline data collection than you would need if you were just doing a simple open pit where you weren't diverting any water sources or anything like that. So, the nature of the project added to the complexity of it. But the other thing for us is we didn't really have the right team in place until, I would say, late in 2020 to really take the project through the environmental assessment process. And so we brought on Steve Lines and Megan Burtonshaw, our permitting and community relations team and continue to add to them through this process. But that was late 2020. So we really kind of restarted, finished up a terms of reference in 21, completed a draft environmental assessment, which we sent to regulators and the communities in 22, spent 2.5 years working back and forth with the regulators, receiving and answering more than 3,000 comments and questions about this draft, making a bunch of changes in scope to produce that final environmental assessment document, which we submitted into the process in 2024, and then it went through a couple of rounds of comments, of public comment periods, and then ongoing discussions with communities and with regulators answering what's been another probably 2,500 comments and questions. So it's just an enormous amount of back and forth, and that's the diligence that the communities were doing on the work. That we had done. It's the diligence that the regulators do on the game plan.
Dan, how often do we encounter a scenario where maybe an EA passes, but then when the pre-feasibility study comes out and the numbers don't make sense, the company backs out of the project altogether?
Not very often. I can think of a couple of projects that we've seen that not that the company has backed away from the project, but maybe, they are reimagining some of the infrastructure around it, or they're not ready to build it, or the work had been done at a higher gold price and then the gold price pulled back. And so kind of goes into a holding pattern. The environmental assessment approvals are a huge milestone. It is a huge asset because it does give you that, really shortens that time frame for you to then drive forward, get your permits and move on. I think we've seen a far more, if you kind of talk about the gold industry here over the last 10 years in Canada, if you go back to 2015, you'd have Rainy River, you'd have Cote, you'd have Magino, you'd have Greenstone, Valentine. I feel like I'm missing another one. Well,
the
almost
key,
would have had
here is
Detour at that time.
what you would look at in the pre-feasibility study to basically give yourself an okay go ahead or no go criteria.
Yeah, I mean, we updated our pre-feasibility study in November, so we have a pretty good sense that the numbers are current. You tend to not change your scope too much going from a pre-feasibility study to a feasibility study. We'll likely have a few scope changes as we go through, but just an optimization and of some of the infrastructure that we'll continue to work on. But things that are going to be inside the scope of the EA. So. Yeah, no, I think that's one of the things. You just kind of have to, get just more degrees of precision as you go through the feasibility process so that you have more confidence in what that number looks like. And when you go to, raise the money to be able to build the mine, that you've raised enough and you're going to be able to deliver that project on time and on budget.
Let's take a look at financing and raising money. Since you brought it up, this is probably one of the most important things that needs to be done before the project initiates, Dan. So right now I'm looking at your company. Your market cap is somewhere between $950 to $960 million. We're looking at a capex north of, I said 300, so maybe you can update us as the number, but it's a significant portion of even your market cap. So investors are wondering, A, what the financing process will look like, and B, how much will my shares be diluted?
Yeah, so the upfront capital of this project, as we scoped it in the pre-feasibility study, was 1.1 billion US. So still significantly larger than our market cap. But there's a bunch of different avenues one can look at for financing big mining projects like this. You've got traditional debt project financing markets, where, banks or groups of banks would come together potentially with some multinational agency lenders that would provide, whether it's, offtake guarantees or equipment guarantees for sourcing equipment from abroad, things like that. If you can put those debt packages together, that are usually 50-60% of the construction capital. You look at the balance of that, that could be, you often would see that, you'd have an element of either some subordinated debt or likely a stream or a royalty that would help bridge that gap as well, potentially. And then you have an equity component. So by the time you really kind of drill down to that, the equity component is quite a bit smaller than the total upfront capital. And this is a robust project, right? So you've got a project with at a $3,100 gold price, which is still, $1,000 plus below where we are right now. You have a project with a 40% IRR after tax and, like a sub 2-year payback. At current spot prices, this project would have a $3.8 billion after-tax NPV and an even more robust payback. IRRs go into the 60s. So very, very robust projects, which means that you should be able to stretch some of those other financing avenues to be able to minimize the equity. But for us, we've also been pretty open about, I think having a real interest in having a partner come in to work with us on this. So whether that's a financial party or a mining company coming in to, basically earn into the project, and their earn in spend, we think, if they want to get 50, 60% of the project, would likely be enough to build, the entire project. The project itself could carry some form of non-recourse financing. And then you have an earn-in that basically is all of your equity component. And so, I think there's ways you can manage that dilution in the right environment. Taking that dilution at the project level might be considerably less than taking the full construction capital dilution in the project equity. Because you got to remember, for us, what's interesting is we also have the Duparquet project, which is 6 million ounces in the middle of the Abitibi. Something that will have, I think, a bit of it has a bit less of an infrastructure burden that it needs to bear because of where it's located. You've got, you're half an hour from a smelter in Rouyn-Noranda. Like it's sort of all easier just based on its geography. So, if we take every dollar of dilution we take at the equity is, I think, a little bit, is something you want to avoid because you're taking dilution on both projects. Whereas if you take project level dilution at Springpole, you're not diluting the equity that we have in Duparquet. So lots of things to consider, but I think those are all things. We got lots of time to do that as we're going through the detailed engineering and in support of the ultimate permitting process. So, those are things that we'd typically kick off kind of towards the end of this year and would run in parallel with your feasibility process and target your financing package to come together, Q3, Q4 next year in advance of a construction decision early 28.
And how does management usually pick a partner, like strategically speaking? Now, you have a few options on the two extreme ends. You can either operate yourself or you could sell the asset completely. And then there's everything in between, anything from a JV, or you could lease out your land, or you could have a royalty agreement, or you could have a partnership where an operator collects X percentage of the proceeds from the production. Is it just a function of price ultimately, or what else do you look at?
No, it's, like any relationship, there's you'd like your long-term relationships to not be quite that transactional. So there's a lot that goes into it. What are the capabilities of the groups that you're working with? What do they bring to bear beyond just money? Because I think just money is available and you're going to do it yourself. We'd still need to augment our team in terms of building up. The full construction process would be, certainly we need to add to the team to be able to go through that. But no, I think when you're talking about partners, there's a lot of things. It's an aligned strategic view. It's the resources that they bring, not just financial, but human capital. It's, balance sheet and ability to withstand downturns. It's someone who, is going to operate the asset effectively, someone with a great track record of, delivering large projects and a commitment to see things through. So yeah, it's lots more than just the dollars that you look at when you think about, who the sort of partners you would be in with for the longer term. I think there's a lot more that you can look at than just that.
When the price of the stock, going back to your share price, when the price of the stock experienced this level of volatility, how does it change? How does the volatility change corporate strategy? So the gold price went from 2,000 to 3,000 to 4,000 to 5,000 very quickly. And your share price reacted that move upwards as well. And in a very short amount of time. It also reflected gold's decline very sharply as well on the downside. So it went from just above 84 cents down to 35 cents in a matter of weeks, really. So 54% move on the downside before recovering again. When these types of swings happen, what kinds of conversations are you having in the boardroom? Do you change strategy?
No, strategy is for the longer term. Like you have to be able to see your way through what is a volatile industry. And those of us who've grown up in the mining business know that it's volatile. And your strategy needs to be able to account for that. Now, the ways that you manage volatility is by trying to make sure that you're never really overextended one way or another, and that you really spend the time to understand what your options are when you make some of the larger decisions that are going to affect, like dilution and ultimately going to, whether you're going to bring a partner onto the project or not. So, we've had continuous discussion in our boardroom about the various different ways that this can evolve. And I think a higher gold price environment helps. A higher share price helps just because it opens up different avenues that really weren't open to us when we were having some of these discussions as a 120, 150 million market cap company 18 months ago, right? So the realm of the possible is much, much larger now. Like the playing field for us in terms of attracting new investors is wide, wide open. And we're still trading at, a fraction of the multiple of our peers with advanced stage projects in tier 1 jurisdictions. Like, we're a 3 or 4x re-rating as reversion to the mean with where our peer group is. So that's also helpful. And it's nice to see kind of some of these big jumps. As you're advancing, you need to do things prudently and think about and account for what some downside volatility could be. But, I think you have to be planning these things for the longer term. And we've been at it for, I've been here 7.5 years. And so there's not much we haven't seen in terms of swings up and down. We just got to stay the course here and keep our head down, get the work done, keep taking risk out of the projects and keep driving on.
Let's talk about gold in the gold mining industry. People in the gold space, the investors, have been looking at the mining industry as a proxy or indicator for what may happen to the gold price. Recall that in 2011, when the then bull cycle ended in 2012, what happened was the gold price retraced back down towards $1,000, all the way up from $1,900, and then we had a basically 6 to 7 year consolidation, bear market, whatever you want to call it. During that time, mining activity stalled accordingly. But there were already signs back in 2011, in retrospect, from the mining industry that could have indicated a bubble pop. Any such overspending in M&A, people buying deals at the top, frenzy in purchases, and then the whole thing deflated very, very quickly thereafter. What can we learn? Well, those are two separate questions. What can we learn from 2011 is one question. But importantly, any parallels you're seeing right now in the mining space?
I think there's a lot to learn from 2011. I think the industry did learn quite a bit from it in terms of, being more prudent in bull markets, in terms of not pursuing growth for growth's sake. I think the industry's kind of done that a little bit, like the producers, to their own peril. Right. I think this mantra of conservatism, which was drummed into them over, almost a 15-year period from 2011, we were in a pretty savage bear market with the exception of like a little pop, really until like 18 months ago. It was the gold price had started moving, but the equity sort of access to capital particularly for project developers, but equity for the sector in general was still very, very poor. So the gold price has responded don't need to tell the viewers on your show, all the macro reasons. But I think everything that got gold to where it is now, is not better. In fact, I think it's worse. I go back to 2011 and look at what the actual fiscal deficits were in the United States when people were hitting the panic button after the global financial crisis, that we had to pump $1.2 trillion in to save the global economy. 1.2 trillion today is like a drop in the bucket of the annual US deficit, right? Like, it's nothing. And we don't see any willingness for central banks and governments to really tackle or deal with that issue really anywhere around the world. Very, very few examples of like a solvent, prudent government, fiscal situations. So, and the US kind of least of all, and particularly this year. So, I don't know. I pray every night for a great outbreak of peace in the world. I think we could all use that, but I'm 100% confident we don't have an outbreak of trust coming anytime soon. And so I think you're going to continue to see gold's consolidating here. If gold has a pullback and is flat at 4,000 for a while, that's still 33% higher revenue than what we forecasted in our pre-feasibility study 6 months ago. Right?
Have the producers' costs increased by 33% at least in the last year?
No, not
so
well. With the exception of kind of the spike of oil prices, which some of them would have hedged, but no, it hasn't. And even that, it's, the actual net impact of an increase of cost was, maybe 20 or 30% of a cost that could be 10% of your input cost, right? So, not huge. I think, we're continuing to see pressure on labor costs in the mining industry, but fundamentally, I think we're still sitting in a place where gold mining companies are going to be generating record levels of free cash flow this year. And, I expect next year and next year. I think, this is a very healthy environment for margins in the gold mining business. And I think it's going to continue to be healthy because I think, like I say, I don't see anything that takes the upside away from a gold trade right now. I think it's a bit of a consolidation. You've had some people who've really had to liquidate some gold in order to deal with the other macroeconomic and socio-political shocks that we've seen in the world this year. But I think we're headed back to an ongoing of the trend that took gold from 1,300 to 5,500. There's nothing that made that movement. Listen, maybe it got a little bit ahead of itself on the way up, but there's nothing to me that says this is a long-term retracement here.
Last year, I was reading some analyst reports on some companies, and a gold price that was commonly used for the NAV, the net asset value assumption, was $2,000. What is it this year? Do you know?
So banks, like if you are lending into the gold sector, I think you'd probably be looking at 2,500 as your, downside. We ran our study 6 months ago at 3,100, which was the long-term consensus at the time. That long-term consensus today would probably be 3,700.
So why is it industry standard to not use the spot price?
At
the time of the report or the study or whatever. The case might be.
I think it's just trying to account for some of the volatility, and particularly when it's going up all the time. So generally, you'll use one of two things. It's either an industry consensus long-term price or 3-year trailing average, which, one's forward-looking, one's backward-looking, and they usually triangulate into something that's pretty close. But, we were looking at our project at $3,100 gold. Well, producers were selling gold earlier this year at, above $5,000 an ounce. So you have this disconnect, and that's really always an interesting part of the M&A business and the M&A cycle in mining, is that you end up with these disconnects between even where the producers themselves have forecast. Like a lot of producer forecasts this year, I would bet are probably like around 3,000, 3,200, maybe 3,500. Just because, gold was continuing to run at that time, and they budget conservatively. But they're going to be generating, depending on when they were selling those ounces, an incremental $500 to $1,500 an ounce of margin, right? So, and that is dropping to the bottom line and dropping to the balance sheet as free cash flow. The beauty of our story is you've never had to really search for where the fundamental value is. These are big economic projects at good grades in some of the best jurisdictions in the world to build projects. And so we've been blessed that way, that we're not reliant on, the next 50,000 meters of drilling to tell us whether or not it's economic. Like, we've got good economic projects here that underpin that value.
If an investor were to say to you, well, first of all, congratulations on your EA, your economic assessment being approved, but ironically, that made you less attractive as a takeout target at 77% stock market gain than before it got approved. How would you respond to that?
Well, I would say anyone who's producing gold today, probably their company's valued at, whatever, $800 to $1,000 an ounce in the ground, maybe more than that. Where the producers would trade. And, other development projects have been bought this year at $400 to $500 US an ounce. And we're still trading well sub 100. Like, we're trading around $50 or $60 an ounce. So there's a ton of fundamental value here. It'll take a little while for us to continue to play catch up, but there's a very clear path to why the share price changes as we start our shareholder base starts migrating a bit more institutional. Anyone can objectively look at what we have now with the environmental assessment approvals, with, I think a really constructive direction we're heading with the communities that we're working with, and see that, again, you got to look at this project on its merits, and it has a lot more in common with the projects that just got bought for $500 an ounce than it does with the ones that are trading at $100 an ounce in the market. And we're still trading at a discount to that. So, yeah, I think, there's no shortage of fundamental value for a corporate or a mining producer to, really be able to justify a much higher value on an acquisition of First Mining Gold. But, that's, we'll see how that plays out over time here. I think there's a very limited number of projects of our scale with environmental assessment approvals in Canada. So just another check the box on the scarcity value. And I think that's going to translate into shareholder value here, either through the market or ultimately, the industry will recognize it. This stuff moves quickly, it's, there's a lot to get done still. But we're very happy yesterday to have a Canada Day to sit back and reflect on,
happy Canada Day.
Thank you. The government of Canada having handed us, this very important authorization on the day before Canada Day. So I'm thankful.
Very auspicious timing to be awarded that around Canada Day.
So we took a day off to reflect on that, and now our sleeves are rolled back up, and we got a lot of work to do. So we'll just get back at it, and I think the share price will look after itself here as we're moving forward.
Great. Well, congrats on your recent success, Dan, and I look forward to many more success stories. Where can we learn more about your company and stay up to date with news?
Yeah, first place is our website, www.firstmininggold.com. And if you want to reach out to anyone, Paul Morris, our Director of Investor Relations, Paul at firstmininggold.com. It's an amazing job of keeping in touch and getting people the information they need.
All right, excellent. Thank you so much, Dan. We appreciate your time, and I look forward to more conversations. Speak to you again soon.
Thanks, David. It's a pleasure.
Thank you for watching. Don't forget to like and subscribe.